SoFi stock is going crazy lately, up more than 100% in just the last 3 months and up about 40% so far this year. More recently, I wrote an article about SoFi explaining why I think the stock will have a monster move ahead. And within a week, the stock rallied more than 15% since that article. But even despite the recent rally, I believe SoFi is still a good buy at current levels. So in today's video, I want to highlight 7.5 reasons why I think SoFi is still a good buy. Not 7 reasons, not 8 reasons, but 7.5 reasons. If you're wondering why the 0.5, well, stick around till the end of the video and you'll get what I mean. Before I move on, I have written extensively about SoFi over at Seeking Alpha, so if you're interested in reading my articles, you can find the link to my articles in the description box below. And with that out of the way, let's jump into the first reason why I think SoFi is a good buy. So the first reason why I think SoFi is a good buy is that SoFi is disrupting banking. In a nutshell, SoFi is a fintech company that offers consumers financial products such as digital banking, lending, and investing, and the company is basically disrupting the legacy banking system through its all-in-one mobile app, financial app, and this disruption can be reflected in the rapid growth of its membership base. And as you can see, SoFi membership count has done nothing but grow and grow over the last few quarters. As of Q3, the company has 9.4 million members, up 35% year over year in the quarter. And although member growth has been decelerating over the last few quarters, which is expected as the company grows over a larger base, SoFi added a record 756,000 new members in Q3, which is just incredible. So growth is actually very strong. And what's more, management continues to expect to add at least 2.3 million new members in the whole of 2024, which means SoFi should end the year with at least 9.8 million members. But considering SoFi's current momentum, I believe SoFi will end the year with at least 10 million members. As a result of strong member growth, product adoption on the SoFi platform continues to be robust, with 13.7 million total products as of Q3, up 31% year over year. And just like new members added, SoFi added a record number of products in the quarter at about 1.1 million new products. Interestingly, if we take total products and divide it by the number of members, we get product per member, which is only 1.46 as of Q3, as you can see right here. In other words, the average member only uses 1.46 of SoFi's products. And for context, SoFi has 9 different major products, namely personal loans, student loans, home loans, money, invest, credit card, referred loans, relay, and at work. So the company's multi-product adoption is still very low, so SoFi still has substantial opportunity to improve monetization through cross-selling. So revenue per product is already high at $81, which is up 52% year over year. So imagine how much higher it can be if, let's say, product per member is as high as 3 or 4 products. And as a matter of fact, management thinks that revenue per product is nowhere near where it can be long term. So for example, its invest product is only monetized at about half the rate. So still so much room in terms of monetization here. That being said, strong member and product growth led to robust revenue growth for SoFi. In Q3, revenue was $697 million, up 30% year over year, which is a record high for the company. And this beat analyst estimates by $63 million, which is just incredible. And more importantly, growth re-accelerated by 10 percentage points quarter over quarter, which is good to see. So as you can tell, SoFi's member, product, and revenue growth is a clear indication that SoFi is disrupting the traditional banking system and that it is taking a lot of market share from incumbents such as JP Morgan or Bank of America, which is one of the biggest reasons why I'm bullish on SoFi. So the second reason is the robust deal pipeline within the technology platform segment. As mentioned by management, SoFi aspires to be the AWS of fintech, and they're trying to achieve this through its technology platform segment, or Galileo, which is the B2B side of SoFi's business. So essentially, Galileo is a banking as a service solution that powers other fintech firms like Dave, Toast, and Robinhood, and even SoFi's consumer-facing mobile app. As you can see, tech platform accounts is growing at a decent pace as well, with accounts of about 160 million as of Q3, which is up 17% year over year. In terms of revenue, the segment generates $103 million in Q3, up 14% year over year, surpassing the $100 million mark for the first time ever. And interestingly, management sees that the pipeline is in a stronger spot than it's ever been, so expect growth to reaccelerate in future quarters, which should serve as a catalyst for the stock. More excitingly, SoFi's financial services segment is still in hyper-growth mode, which is the third reason why I believe it's a good idea to buy SoFi stock. As you can see, the segment is growing exponentially, now with revenue of $238 million in Q3, up a whopping 102% year over year, which is just astonishing. And this was driven by a 66% year over year growth in net interest income, and more prominently, a 235% year over year growth in non-interest income. So the faster growth in non-interest income was due to the growth of the loan platform business, which grew 5x in the quarter, generating $61 million of revenue in the quarter, of which $56 million was in the form of loan platform fees recorded in the financial services segment. So I believe the loan platform business has been around for a while now, but I think it has only gained traction in the last few quarters, especially the most recent quarter, as demand for personal loans have accelerated due to the interest rate cuts. In fact, the loan platform business originated about $1 billion of personal loans in Q3, which is why we see a spike in revenue growth from the loan platform business. And of very important note, loans processed through the loan platform business does not involve SoFi taking any balance sheet risk, as the loan platform business only generates loans on behalf of third parties, so SoFi does not hold those loans in its balance sheet. And what this does is that it allows SoFi to generate meaningful cash fees upfront, and this expansion to a fee-based capital light and lower risk revenue source allows SoFi to serve the needs of more members at a more rapid pace than ever before, which should contribute to robust top-line growth in the years to come. That being said, with the rapid growth of the financial services segment and the technology platform segment, the non-lending side of the business combined together grow by 64% year over year to $341 million of revenue, which has now make up more than about 49% of the company's total revenue, which is up from just 39% a year ago. So this reflects SoFi's diversification strategy, and this will enhance the narrative that SoFi is more than just a lending platform and that it is a diversified all-in-one financial platform. And speaking of which, another reason to like SoFi stock is that growth in the lending segment is re-accelerating, growing 14% year over year in Q3, generating $396 million of revenue. And this is due to the recent interest rate cuts, and now that SoFi is entering a lower rate environment, management expects an uptick in demand for its student loan refinancing and home loan businesses. And as for the personal loan business, management is already seeing excess demand, so much so that SoFi has to decline 70% to 80% of personal loan applications. And as management mentioned, there's a lot of upside and it only gets better from here, which is why they are expanding the loan platform business aggressively to fulfill that demand. So moving forward, I think we're going to see the lending business really gain a lot of traction, and I think that's going to push fundamentals to new heights, which should boost its share price as well. And the crazy thing is that rates are still high and the Fed has only cut rates by a few basis points. So imagine how big the lending business can get once the Fed cut rates by another 1 or 2 percentage points. The next reason to be bullish on SoFi stock is that the company continues to drive operating leverage and subsequently higher profitability. So as you can see, here's a table of contribution profit by segment along with its total contribution profit. And as you can see, contribution profit in its latest quarter was a record high of $372 million, with all three segments producing record contribution profit as well. But more impressively, total contribution margin was a record 54%, expanding by 9 percentage points year over year and 6 percentage points quarter over quarter. So this margin expansion was largely driven by its financial services segment, which saw contribution profit of $100 million at a 42% contribution profit margin, which expanded by 39 percentage points year over year. And to expand that further, the financial services segment generated $120 million in incremental revenue with only $24 million in incremental expenses. So the segment is definitely gaining a lot of operating leverage, which is very exciting to see. And because of this, I believe overall contribution margins will continue to expand from here. Adjusted EBITDA was $186 million in Q3, which is a record high for the company, representing an adjusted EBITDA margin of 27%, which expanded by 9 percentage points as you can see right here. In addition, incremental adjusted EBITDA margin was 56% in Q3, way higher than its actual adjusted EBITDA margin of 27%. And this indicates that adjusted EBITDA margins still has more room to expand, possibly to the 40% level, which is incredibly profitable. In terms of the bottom line, net income was $61 million in Q3 at a 9% margin, which improved by 13 percentage points year over year. In addition, GAAP earnings per share was 5 cents, which improved from negative 29 cents year over year, which beat analyst estimates by 1 cent. So as you can see, despite growing rapidly, SoFi was able to deliver strong operating leverage, and it seems like it will continue to do so for the foreseeable future. And I think this is going to be a recipe for explosive earnings growth. And this is somewhat reflected in management's guidance, which they have raised once again, which is going to be reason number 6. As you can see, management now expects adjusted net revenue of $2.55 billion at the high end, which implies a growth rate of 23% year over year. And this is up from $2.465 billion previously, which implies a 19% growth. I think the raised guidance was mainly driven by the lending segment and the expansion of the loan platform business. That being said, management also raised their profit guidance as well. Adjusted EBITDA is now expected to be $645 million at the high end, representing an adjusted EBITDA margin of 25%. And this is up from $615 million previously. And in addition, they expect GAAP net income of $206 million, which is up from $185 million previously. And this should translate to about 12 cents of GAAP EPS, up from just 10 cents previously. So the raised guidance across virtually every single metric is definitely a welcome sign that growth momentum remains strong and that the company is expected to gain more operating leverage, which is always good to see. Now, reason number 7 is that SoFi maintains a strong balance sheet. As you can see, SoFi's loans and deposits, which are the blue lines right here, continue to grow with each passing quarter, with loans of $26.6 billion as of Q3, which is up $1.3 billion quarter over quarter, and they also have customer deposits of $24.4 billion, which is up $2.4 billion sequentially. So the growth of the customer deposits is very important as it allows SoFi to fund its loans using deposits rather than debt, which translates to higher cost savings, thus resulting in higher earnings growth. In addition, SoFi's credit performance is the strongest it has ever been. As a matter of fact, SoFi's recent loan vintages, which in this case is Q4 2022 to Q4 2023, they are performing better than its 2017 loan vintages, which happens to be the last yearly vintage that approached 8% net cumulative losses or NCL. So as you can see, SoFi's newer vintages are trending below the 2017 loan vintage, and at 49% of remaining unpaid principal balance, net cumulative losses or NCL were 3.33% for the newer vintages, which is much lower than the 4.77% seen in the 2017 loan vintage. Additionally, 57% of SoFi's Q1 2020 to Q2 2024 personal loan originations have already been paid down at a 6% NCL. So only 43% of the principal is left unpaid, and for the entire cohort of loans to reach 8% NCL, the remaining unpaid principal will need an NCL of at least 10.4%, which is very, very, very unlikely. Because if you look at the previous chart here, you can see that the NCL curve starts to flatten during the later stages of the loan vintage. So credit performance is likely to get better from here. And with lower expected NCL, management expects greater returns from its recent loan vintages. In fact, according to management, they expect returns greater than 2x versus 2017, with newer vintages expected to produce ROEs above 30%. Ultimately, stronger credit performance will lead to higher earnings growth, and that is what we like to see. Okay, the last reason number 7.5, is valuation, and you might be wondering what's with the 0.5. So let me explain. So about 3 or 4 months ago, I wrote this strong buy article on SoFi highlighting 8 reasons to buy SoFi stock and why I think SoFi is a generational buying opportunity at about $7.57. And since that article, the stock has exploded by more than 80%, from $7.57 to about $13 to $14 today. So the first 7 reasons from that article are already mentioned in this video, but the last one, the 8th reason, is valuation. At that time, SoFi was trading very cheaply at just $7.57, but because of this violent rally in the last month or so, SoFi doesn't look as attractive now. I mean, just look at the price action. The stock is basically going parabolic in the last 3 months, up more than 100% since its bottom in July or August. That said, I think SoFi stock has gone up a little bit too fast, which is why I think we might see a pullback in the near future. And when we get that dip, probably to the $10 or $11 level, I think that will be a good buying opportunity on SoFi stock. Intrinsically, I have a base case price target of about $17.76 for SoFi stock, which represents a 12-month upside potential of about 26% from its current price of $14.11. So while I think SoFi stock deserves a higher valuation, I think the risk to reward in the short term is not as good given the recent spike in share price. On the other hand, there are some catalysts for the stock, such as S&P 500 inclusion because they are already GAAP profitable for 4 quarters in a row, and further interest rate cuts could also boost the business as well as serve as a catalyst for the stock. So as you can probably tell, I'm a little bit mixed about SoFi in the near term, but in the long term, I'm still bullish on the company, which is why I only gave a half-point rating for valuation. So that being said, those are the 7.5 reasons why I think SoFi is a good buy today. So as a summary, here are the reasons again. So first, SoFi is disrupting banking as seen with its rapid ecosystem growth. Second, its tech platform is seeing the strongest deal pipeline in a while. Third, the financial services segment is in hypergrowth mode, growing at triple digits. Fourth, lending activity is picking up once again as interest rate cuts starts to fall. And fifth, the company continues to drive operating leverage and profitability. And sixth, execution has been on point. The company continues to beat expectations and raise guidance time and time again. And seven, The company has a strong balance sheet with improving and strong credit performance. And last but not least, the stock is undervalued, although I would be cautious in the short term given the recent rise in the share price. So there you have it. These are the reasons why I think SoFi is a good buy. What do you think? Please let me know in the comment section down below. And with that being said, this is all that I have for you today. If you enjoyed this video, please leave a like and subscribe to my channel for more investment content like this. With that being said, thank you guys so much for watching this video. I'll see you guys in the next one.